How do you guys do this thing? Hi everyone, welcome back to my YouTube channel. Since I'm still a little bit new around here, a little reintroduction wouldn't be out of place. My name is Adeola Monofi and I am a money and business coach. So today I'll be giving us a few tips on how we can make money during market downtimes. With the recent happenings around the world, high interest rates, inflation all over the place and all that, the financial market have not been smiling. Like, the performance last year was nothing to write home about. But there are still a few useful tips that you can use to make money even during market downtimes. And those are what I'll be sharing with you today. So stay tuned. The easiest way to make money during a market downtime is through the concept called dollar cost averaging. What does dollar cost averaging mean? Dollar cost averaging is the practice of investing a fixed dollar amount into the market on a regular basis. This could be on a weekly basis, on a bi-weekly basis, or on a monthly basis, but it involves you investing a fixed dollar amount. Could be $50, $100, $200, or whatever dollars, but a fixed dollar amount into the market on a regular. Now, how do we make money in a downtime using dollar cost averaging? Just take a look at this graph. It represents two markets. Market A is the first one on the upward trend. That's the one we love, right? And then there's market B right here, where the market is not quite friendly. It's just dipping before it went back to the position where it started in the first place. Now let's look at these markets more closely. So market A started out with a share price, a fund price of $10 per unit. So, and then the next month, the share price went up to $12.50. And then the next month, it went up to $20. And then the next month, it went up to $25 whooping dollars. Everyone loves that kind of market, just going up. And then take a look at market B, on the other hand. Started also at the share price of $10 per unit, came down to $5 per unit. Nobody likes that. That's 50% down. And then, as if that wasn't bad enough, went down to $2 per unit. Gosh, are you kidding me? Only for it to at least come back to the point where it started in the fourth month. Now, let's take a look at you and your money and what it means for your money. So, assuming you were just this regular guy who loves to invest, and then you were investing in market A, and you're investing a fixed dollar amount of $100 monthly on a regular fixed dollar amount on a regular dollar cost averaging. Don't forget that, right? So you have this fixed dollar amount of $100 and you're investing it every single month in the financial market. The first month, let's call it January, you put in $100 and the stock, the value of the share or the fund was $10 per unit. So you're able to buy 10 units with your $100. It's just 100 divided by 10, right? So 10 units you acquired right here. And then in month two, another $100 was deposited into the fund. And because the value of the stock is now $12.5, you're only able to buy 8 units. And then the next month, the value of the share went up to $20. This time, with your $100 regular contribution, you're only able to purchase 5 units. And then in month 4, the market went up to $25 again. This time, you're just able to purchase 4 units. At the end of the 4-month period, you were able to purchase a total of $27 with $400 worth of contributions on your part. Now, let's take a look at the experience in market B. In market B, you contributed your usual $100, and in the first month, you were able to purchase 10 units. But then in the next month, the market dipped and the value of the share came down to $5. The stock is on sales, guys. That $100 allowed you to purchase 20 units this time of the same stock. And then in the third month, the unit or the value of the stock went down to $2 per unit. and you contributed your regular $100 and purchased 50 units of the same stock or of the same fund. And then in month 4, all the market did was went back to the position where it started in the first place at $10 per unit. And now you're able to purchase 10 units once again. And then at the end of the day, you are actually able to have accumulate the total of 90 units in that 4-month period with a total contribution of $400. Now, let's assume that you wanted to cash out at this point. Who has made more money? Well, in market A, you're going to be selling your units at the current market price in month 4, which is at $25, and you have 27 units. 27 units times $25 goes ahead to give us a total of $675. Congratulations, you made money. You contributed a total of $400, and at the end of the day, you were able to sell your units for $675. That's $275 of profit. But let's check out what it was like in market B, because now we're selling the 90 units we purchased at the current market price of $10. 90 times 10 is $900, guys. Who made more money? The guy who was investing in the market that was going on a downward trend. And trust me, whenever the market goes down, it comes right back up. All the market had to do for this guy to be in profit was to come back to the position where it was in the first place. Right? Now, these are just examples and simulations. I don't know any fund that goes up like this, but I'm sure it's possible. Nothing is impossible in the financial market. But I hope you get the whole idea of how dollar cost averaging helps you to make money even during the market downtimes. So when the market goes down, most people react by, oh, I don't want to put in any more money. Oh, I want to go and take all the money. You only lose money when you cash out during a downtime. It's like buying something for $100 and then selling it at $90. That doesn't make any sense, right? Especially when you're invested in funds. Funds are well diversified. You have nothing to be afraid about. Just have a long-term perspective when it comes to investing in the financial markets. Be patient. Don't be emotionally attached to your funds. Don't be emotionally attached to your money. And don't put money that you need in the short run in the financial market, because the financial markets would fluctuate. That's the normal behavior of the market, guys. But in the long run, there's always growth. So all you need is patience. All money needs to grow is time and good interest rates. So that's it for today, guys. I hope you learned something new, and I hope you won't be chickening out when the market goes down. Rather, you would commit to regular contributions into the market. Thank you so much, and don't forget to subscribe, like, and drop a comment. Are you already familiar with the concept of dollar cost averaging? What are your thoughts? Please feel free to share with me in the comment section. If there's any other topic you would like me to talk to you about, feel free to share it with me in the comment section as well. Thank you so much for dropping by my channel today. See you next time.